So thanks a lot, guys, for popping by.
Yeah.
This will be
Thank you.
this will be quite fun. And like I said, like as soon as it's about like investing, the numbers tend to go up a lot higher. So
One would hope it can go up and go down. There's upside and downside risk.
yeah, there we go. Well, how does Era predict this one coming out?
This isn't one of the inputs to the model. Audience participation. I'm your idiosyncratic risk here.
Anyway, thanks a lot, guys, for for those who have joined. Thank you so much for joining us already. So today we do have the pleasure of having Ken from StashAway, the country head of StashAway in Malaysia, joining us.
Okay.
Ken, if you don't mind, just kind of introducing yourself, quickly introducing StashAway for those people who might not be aware of it, and then we can dig in right in.
Hi CS and hi Reggie. Thanks for having me on the show. So for all of you out there listening in live or later on, I know that you have nothing else better to do at home anyway. I know you've seen all the Korean dramas on Netflix, so I'm glad you guys are tuning into this. My name is Ken. I'm the country manager for StashAway. StashAway, who of those few who don't know, we're a robo-advisor, or in Malaysia we're called a digital investment manager or a digital fund manager. We make it really easy for people to invest. We offer portfolios of different risk levels, all made out of ETFs of different asset classes. So I think it's really timely that we have this conversation because the shit has hit the fan. It's the end of the world as we know it. All has changed. S&P has hit a wall, right? Have we found the bottom? I don't know. Maybe there's a basement, so we'll find out.
Perfect. Yeah. So I guess let's start right in that spot then. Like, how are you guys handling this crisis, or how has this crisis played out compared to what you guys thought it would play out?
So great question, and it's obviously very contextual as well. If you look at the S&P 500 chart, especially if you look at it on very long term from the 1980s, you will not only see obviously a lot of dips along the way. For example, during the tech bubble and during the global financial crisis, but also you will see that it literally like hit a wall because it lost around 30%. Within a span of 3 weeks, right, guys? And basically it's rebounded to around year to date now. It's down 22%. So still definitely not calling the bottom, and still definitely not saying that we're going to recover. But the speed of which of this crisis is really astounding, right? And it's something that we didn't predict. I think the basis of every crisis is one where it was not predicted. It's to use the phrase a black swan. It's a very long tail event, and it hit everyone by surprise. So I think what we thought would have caused the next crisis would be U.S.-China trade relations or Chinese debt or something like that. We didn't expect it to come from the US. We didn't expect it to come from Europe, but it was an external health scare which really impacted the economy as a shock, and that also led to an oil shock and geopolitical tussle between OPEC and the shale producers. So this 1-2 punch has really taken the air out of the market. And as you guys know, it's about repricing in what we know from a day-to-day basis, right? So obviously, the first week of the drop was relatively mild. I think most of the drop came in the second and third week, where it was huge swings down followed by huge swings up, circuit breakers upon in both directions, and ultimately when you hear this is the worst since 1980s, 2008, 1930s, then we're in unprecedented times.
Perfect. Yeah, so I guess just some technical things for some people who might not have fully understood that. The whole circuit breaker thing is just the idea of, or it was actually introduced after some other scenarios in the past, right? Where the stock market suddenly dropped 20-something% in one day.
Yeah.
And that's when they're like, oh, this is an issue because the next day it bounced up 20-something%. So as if nothing happened, right?
Yeah,
so
flash crashes.
yeah. So the circuit breaker was created to prevent things like that from happening, because of course, if that happens, then it's really messy for a lot of investors
Yeah.
going forward.
Yeah. So I just realized I didn't answer the second part of your question, your question, CS, where you asked how are we handling all of this, right? So for those of you out there who use StashAway, you'll know that we also have an investment framework called ERA. ERA stands for Economic Regime Based Asset Allocation. If for those of you who don't know, there's a lot of material on CS's website and also on our website where you can understand how we invest. Just look up for ERAA. It's a brainchild of our CIO, Freddie. So how exactly does ERA work and what is it doing for you in this situation? So ERA actually signposts where we are in the economic cycle. It gives you an optimal portfolio to basically invest through the cycle. To double click on that, basically, we see as you go through your life, you'll go through different economic cycles, right? You go through a recession, a recovery, and you go through a phase of inflationary growth, and then maybe back down to a recession or that kind of cycle, maybe even a stagflation or two. So we give you guys the best asset allocation based on where we are in the economic cycle. We don't make market predictions. We don't use machine learning or deep learning or AI or anything of that sort to really predict what's going to happen, right? So we take into account economic information, things like the Conference Board leading economic indicator index, industrial production, and also inflation to determine where we are in the economic cycle. On top of that, we also have some risk management frameworks to make sure that we don't do too much and don't try and be too smart. So for example, if let's say we see growth being on the border of a recession and good times, Reggie, I think you'll know, being in the financial market, sometimes financial market signals conflict with economic signals. We actually go through an all-weather strategy where we diversify even further. And then when the economic indicators are more clear, let's say it's a -5% recession, then we will allocate more towards a recessionary proof portfolio. And then we also use technical analysis, things like golden crosses and death crosses to determine when and where we changed asset allocation, because sometimes financial markets move very quickly, as you know. And the last thing we take into account is valuation gaps. So because the financial markets are forward-looking and they're a voting machine, sometimes they get it wrong, right? Whether we're right or we're wrong, it really depends on the time frame and how solvent you are to make sure your trade goes well. But if we see some valuation gaps, let's say something is undervalued, for example, gold in 2017, we would actually allocate more of our portfolios towards gold as we did in that time, and it's proven to benefit our users. So all in all, how this relates to this current situation, the long story short is that the portfolios haven't readjusted or what we call reoptimized to this particular scenario. Firstly, because the speed in which it happened was very, very quick. And to make any kind of human judgment and not rely on the system we've built and has been stress tested is basically saying that our model doesn't work, right? And based on our model, of course, the things that are supposed to happen. If you're in a low risk portfolio, you're protected. If you're in a high risk portfolio, you go down a lot, right? In good times, you also go up a lot. So we're seeing a lot of swing in terms of performance for a high risk portfolio. And based on that, we haven't done anything because we are also seeing that the policy bazookas and the quantitative easing that has been announced, as we've learned from the 2008 financial crisis, will kick in and provide some support. Not saying we're at the bottom, not saying we're out of the woods, right? But we're saying that it gives some support. And if there's some relative value to be had, we might actually increase our allocation to certain sectors.
Yeah. Actually, speaking about risk, so one of the things that I kept running into when we first started talking, like maybe half a year ago, let's say, was a lot of people trying to say, I got, when I did my survey thing, I got I was classified as a 20 to 24% type of risk person.
Right.
But then they wanted to change it to a 36 because they were like, oh, that's how I can make more money. But of course, now that we're in this situation,
Yeah.
they have probably lost a bit more.
Yeah.
That said, is it possible for you to give us a range as to, from year to date, so from the beginning of 2020 to where we are today, how has StashAway done from a returns perspective?
Yeah. So to answer that question directly, year to date, our portfolios, and there's 12 of them, actually range from +2 to around -20. I think that year to date number might be a couple of days old, so end of last week. So from +2 to -20. And obviously, if you were to judge anything based on 3 months worth of data, it's just a reflection or a snapshot of where we are. And also, as you guys will know, as seasoned investors, looking at a portfolio when it's negative doesn't mean that it doesn't work, right? We're not questioning the underlying quality of the portfolio in terms of the asset allocation or even the multi-asset approach, right? I think what we are questioning is where will it get worse, or am I in the right risk portfolio, right? So just to give you a bit more balanced answer and view, in 2019, our most conservative portfolio did +14% in ringgit terms, and our most aggressive one did +33%. So high risk, high return is proving to be true, and the portfolios are doing exactly what they're supposed to do. So when you get about your comment earlier, CS, when you get recommended a portfolio that is 22% or 18%, it's really tagged on your personal situation, and a lot of weight goes towards how long you can actually invest. As savvy investors, you guys know, especially Reggie, you know that the longer you invest, the higher risk you can actually take, because you can ride out cycles like this one, right? So if, let's say, someone set a 15, 20-year goal for their portfolio, then obviously they will get recommended something around the 20% risk profile. And if they upped the risk, it's against our recommendation, but it's well within your freedom to express your view, right? To express your investment view. And you're down right now. I would ask you two questions. Obviously, we can move on after this, but I'll ask you two questions. Are you liquid? / do you have more capital? And do you have more time, right? So do you have more capital to dollar cost average in these tough markets? And do you have time to wait it out, right?
Fair. I think you talked a lot about economic cycle. Right? I'm kind of backtrack a little bit, right? So
Sure.
When you keep talking about economic cycle, I'm kind of curious, what is your house view, right? Like where do you guys see in terms of economic cycle? Where are we? Because different people see it differently. I'm come from a position that we are already in a recession. Right. So I'm kind of curious, where's your house view? What are you guys seeing?
Yeah. So the thing about recessions obviously is that there's on a country level, and then there's on an aggregate level. And what StashAway's investment platform does is, my hands, is we actually overlap US and actually global economic numbers, and we express that in a portfolio itself. So it's possible for the non-US part of the portfolio to be in an all-weather strategy like it is now for the non-US, because we were slowing down in China even before this. Not in recession, obviously, in China, but slowing down. And then in the US, we were seeing actually very, very healthy, robust growth. So the US part of the portfolio is still very much into growth and cyclical asset classes, things like consumer discretionary, tech, and all that. So to your question about the view, so what we are seeing in the market right now is basically pricing in an expectation for a recession already, right? But as you know as well, the data out there to confirm whether we are in an economic recession or not, or at least in negative territory, we may not be in a technical recession yet, is maybe not out yet. But of course, there are some leading indicators to signal that we are in a recession already as it speaks. I'm sure you all noticed the jobless claims in the US spiked, higher since it was recorded. So obviously a very, very leading indicator about where we will end up in terms of how deep the recession will be. So we also don't really make predictions in terms of saying, oh, next quarter will be in a recession, right? Which is why taken the human guessing element or the crystal ball element out of it, and ERA really focuses on actual data. So when the industrial production comes out in a week or so, both for the US and around the world, then we'll have a very good indication of where we are, and then the portfolio will adjust accordingly.
Fair. Thank you. And I think a lot of people need to understand the difference between economic cycle, right, and like the stock market. Right. So I think we all are on the same position in terms of like seeing how the economic ride out, but nobody can really kind of predict the stock market movement, right? Which is like the day-to-day swings are pretty nuts, right? So I'm also a little Do you have something to share about that?
No, I think it you know, with the word you use there is that it is crazy, especially if you're a long-term investor, right? Because you know you're focused on the long term, but then in the interim you have a lot of volatile markets, and I think people are very used to volatility by now. You know, I think they're primed for that. But this is hyper volatility, right? You know, when we're seeing crises and things like that, so it is nuts. And I won't ramble on, but when markets are bad, you know, a lot of sayings come to my mind, you know, maybe more philosophical now that you're down. You know, Mike Tyson used to say everyone has a plan until they get hit in the face, right? Everyone's like, I'm a long-term investor. I'm going to be in it for those multi-decade gains, right? And then when they get hit in the face, like they are now, maybe not once, but twice, then it's like, it's very hard to remain sober and like, not panic like you mentioned, right? It's nuts, right? So stick to your plan. I'm sure we'll talk about more behavioral stuff later on.
So do you have any suggestions for those people who want to be long-term investors, but maybe just emotionally right now they're just like, it's hard to be one? Is there anything that you suggest them to do?
Yeah. So as emotional beings, right, we all go through different cycles, and those cycles may very much mirror the stock market, right? You know, you have elation and greed, and then it goes to like shock and then sadness and then like depression if you haven't sold your portfolio already, and then maybe some glimmer of hope from a relief rally, or maybe you're seeing some names of drugs that are coming out. You hear the words clinical trials, you know, then some hope comes back, then you might express your view differently. But then no one said long-term investing is hard, right, guys? I think we all have portfolios here. It just depends on what kind of style we are best suited to. So the first thing is to really be honest with yourself. Are you a long-term investor? You might be a closet trader. You might be a closet short-term investor. And then that's fine. You can still learn to have a part of your portfolio be for the long term. And no one said it was easy. So I think for people to really be in a portfolio for the long term, the first thing I would really advocate for is best practices, right? So a little bit motherhood statements, a little bit too homespun, but like the first one is always have a cash buffer of 6 to 12 months, so you're not desperate when your gains are down. Secondly, never use leverage. I wouldn't go on margin or anything like that. Try and be too smart, right? Like you don't want to owe anyone anything, so definitely don't go on margin. So that's point number one. Point number two is definitely invest in a diversified portfolio from day one, right? As savvy investors, you all will know that there's a possibility to be whipsawed. You're in the wrong position. You're like, oh, cyclicals are down, I'm going to switch out, and then the next day it recovers, and you're like, oh no, and then you switch back, and then it goes down again. And when you switch out of cyclicals and you go into safe asset classes like gold has run up 20% since December 2017. Right? Do you think bonds have sat still this whole time? Bonds have also rallied. It's like, oh, you want to run to dollar? The dollar index has gone up. I don't know how much, but against the ringgit, it's up 7%. It's come back down to 6.5% now. So it's too late sometimes to course correct. So I'd say start day one with a diversified portfolio, right? Don't just focus on equities. Don't just focus on those hot stock tips that your banker friends tell you, right? Have those for sure for excitement, right? But then in your portfolio, you also need some broad equity exposure to certain indices, certain geographies, bonds for sure, very neglected. Gold, and then maybe even some selected REITs.
Yeah, interesting. When you say bonds are very neglected, I think I can agree on that. Nobody really talks about the bond market, right? And it's very interesting because at this point in time when volatility is so high and a lot of corporate risk priced into the bonds, so bonds are at a very attractive position at this point in time, right?
Yeah,
But everyone is
yeah,
still talking about equities, right? So I'm
for
quite
sure, for sure.
I'm quite curious, where do you see bonds?
Yeah.
Like, do you guys get like any kind of broad-based, bond exposure, or where is the focus in terms of the bond market for
Yeah,
you guys?
I
Yeah.
love that question, Reggie, because bonds get so little love even in the best of times. They are they are great investment tool because they give you portfolio insurance, right? Like if your net worth is all tied up in equities, then your net worth will be very very volatile. But if you have some bonds thrown in, I think you would do very well for your long term investing needs. So coming back to bonds, I think firstly we focus on government bonds, especially the shorter tenure bonds. Um, Technically, there'll be bills or notes already because they're less than a year, and then the longest tenure we're seeing have some attractive yields, 1 to 3 year bills. So we like that because I'm sure you guys haven't forgotten the inverted yield curve, right? Before all this coronavirus became the rage, people were very worried about where the yield curve were. We're not. It's not inverted anymore, but it is indeed flat. So you're basically getting the same yield for shorter tenure. So we are in shorter tenure government U.S. government bonds right now, and also we are into international corporate bonds because U.S. long-term bonds are basically close to zero by now. So international corporate bonds and also international developed market bonds are definitely there. So in terms of capital gains, I think they're holding their value. I think they're up like 2% because people there's some flight to safety. But naturally, yields will go down because they're more popular in this point in time. So the principal goes up and the yields go down. I would also say that inflation-linked bonds get very little love because people don't know what they are, don't know how to get them. But like we have some ETFs that have that exposure. So with inflation not being concerned per se, but it definitely holds its value. And if we do go into a inflationary recovery, you definitely want some inflationary protection there.
Yeah. Oh, can I ask more question? Yes.
Of course,
So
of course.
I think when it comes to government bonds, right? I think everybody
Yeah.
kind of agree that it is like as good as a safe haven. As long as the government doesn't go insolvent, they can pay back. I think that is cool. But like what
Yeah.
you said, we observe that government bonds are at zero or in negative territory. In fact,
Yeah.
all the major governments, apart from China, which is still giving about 4.4% flat rate on their uh, kind of interest rates. Everyone else is like zero or negative, right?
Yeah.
So when you say like you guys are getting exposure in terms of corporate bonds, right, which is
Mm.
very exciting at this point in time, I get it, but does it then lose its essence of being a safe haven? Does it then lose its essence of bonds being that protective mechanism because you're
Yeah.
taking on risk in the corporate bond market, right?
Yeah, yeah.
Yeah.
So it really depends on what grade you're looking at, right? So and that's why a corporate bond ETF is a really good way to get exposure because if you get single names, I'd be very worried about certain types of corporates. No need to say the airlines, right? No need to say things like that are the oil and gas, right? Those bonds. That's why if if we when we invest we use ETFs, and because they are a basket of securities, if any one of them go down, they get smoothened out by those who still do well. I think we are definitely not into the corporate bonds for capital gains. We're still in it for protection and also a bit of the yield. And it's still in the investment grade, right? So we haven't even gone down to like anything in the B. So I think it's all still in the AA and triple A's.
Okay, that's cool. Yeah, is it too much if we keep talking about investment tools? It's okay, right?
It's
Yeah.
your
So
show, guys.
yeah, I got another question about REITs, right? So I think before '08, during the Asian financial crisis, that period of time, REITs wasn't that popular, right? REITs really became very popular
Okay.
in the past 10 years. So then
Mm.
it has become quite a viable, alternative to bonds, right? Because it does give you that kind of comfortable capital yield, right? Cash has a kind of cash generation capacity,
Mm.
and the physical assets does hedge in terms of market, kind of movement. So in terms of REITs, like where are you guys, and what? So you have a range of portfolios, right? What kind of
Right.
portfolios amongst your 12 portfolio actually has that kind of REITs coverage, right? What
Yeah.
kind of REITs are you guys in? I'm curious on that. Yeah.
Yeah. So while you're asking that question, I was pulling out our list of ETFs. just so I can give you guys the actual ticker itself. So the two REITs that we have in our universe is both by Vanguard, VNQ and VNQI. So one is US based and one is international. I will say that actually none of these REITs are in our portfolios now because they're more suited towards inflationary growth or maybe even in a recession where certain types of yields REITs actually do well. So we're not actually positioned in any REITs right now. And I would say there'll be a time and place for it. So if we go into a recession, I think we there's a chance that we might get that allocation, and it really depends how much. If you're Malaysian and you're listening right now, I think I wouldn't actually touch anything that is into retail REITs, obviously, because no one is out there, and a lot of REIT owners are doing the right thing by giving those tenants rent holiday. All your major malls, are closed, and it's very unreasonable to extract rent at this point. So I actually wouldn't touch those yields because those REITs, because those yields are not secure, right? But after all this is settled, Reggie, you're absolutely right. A REIT is basically a bond where you have a very fixed asset and it gives out a very stable yield. So it has all the attributes of a bond. And I think for certain tax reasons as well, like because it's technically not a bond, there's no like withholding tax and stuff like that. So it's also a pretty nifty way. In Singapore, I don't really have a view in terms of the REITs in that universe. But I will say that in our Singapore income fund, it's called StashAway Income. Basically, it aims to give you 3.7 to 3.9% yield, which is very, very stable income, quality income, as we like to say, because a lot of income funds just brand themselves that way, but there's capital gains based in there. But we give you a 3.7, 3.9% yield, and that one has some Singapore REITs.
Cool. Thanks for sharing.
For those who so you mentioned StashAway Income. I haven't heard about that before. But is it only
Malaysian?
So that means at this point Malaysians can't get access to that, right?
Yeah, no, strictly no. But if you actually want to, you can actually sign up on the StashAway Singapore platform. All you have to do is change the geolocation from the Malaysian flag to the Singapore flag. Put in your passport, and then basically you transfer your ringgit into Sing dollars, and it's a very good way of hedging your ringgit risk because change of government, oil price down, you never know what's going to happen to the ringgit, so you always want a little bit stashed away in Singapore. I think that's what a lot of high net worth and smart bankers do.
Yeah. Cool. Yeah. So when you put it this way, right, does it mean that in different markets that you operate, the government kind of restricts the kind of portfolio that you can structure, what kind of tools you can use?
Oh no,
that's why there's this difference. Or why is there such a difference?
Because our HQ is Singapore, and we actually saw a lot of demand for yield and income type products. We rolled that out, and then when you roll out products, you need the ingredients, right? And we saw the Singapore market has a lot of those yield type ingredients. Obviously, so many more REITs, some dividend yielding stocks, and then also the Singapore bonds. I think that put a very nice portfolio together. And we also have the selection of ETFs that were available on the SGX. And in Malaysia, the ETF scene is still very underdeveloped, and there's probably, I'd say, one or two good ETFs in terms of liquidity and size to be able to be a tool of your asset allocation, namely the bond one and maybe the gold one, but REITs one, not so much yet. There isn't even a REIT ETF. So because there were ETF REITs in Singapore, we started thinking about this. But it's definitely, it's more by investor appetite and not so much restrictions, right? So we are also thinking about ways to introduce it to Malaysian customers, but we're still doing our R&D, and it's only been a year and a half since we launched the global portfolios.
Cool. Thanks for sharing.
No worries.
Yeah. I think some of my followers, right, like in Singapore, I mean, let's not hide from the thing, right? The recent issue with Smartly is definitely affecting
Yep.
the kind of confidence with like robo advisors. For me, I see the position of robo advisors. There's a lot of DIY capacity to it. It's much simpler. It's a lot of consumers, a lot of young millennials. We're just more used to such a way of doing things. Compared to meeting people back and forth. So I see the position for robo advisors, but I think a lot of people want to find some comfort in something that is relatively new compared to all the old agencies they've been around for a long time, right? So I don't subscribe to the whole like longer means better kind of thing, but I think we need to get some clarity in terms of like how do you guys manage your funds? Is there a difference between like money for business and money for investment? If as an investor I pass you my money, how you guys kind of work with that? I'm just kind of curious on that part.
Let me start with the tail end of your question first. So in both Malaysia and Singapore, we have a trustee structure and we use custodian banks to actually receive your monies. It is not to be used for our own working capital, and at no time can we dip into that AUM or that assets under management for us to pay off our expenses and things like that. It's technically under a trustee's balance sheet and kept in a custodian bank. And the only thing we can do to it is instruct it to be invested or withdrawn, and that's it, right? So in terms of that operational and compliance way of operating, we are completely safe. Obviously, we are also MAS regulated and SC regulated in both countries, and based on that, we also have to do a lot of reporting on a monthly and 6 monthly and 12 monthly basis. So we get audited to death, really. But that's the name of the game, right? So I'm coming on to Smartly. I'm very glad you asked that question, because sometimes the media and those who are maybe uninitiated, right? But we are not uninitiated, right? We can separate the hype and all that from the truth. And I'm glad you asked that question, because in fact, Smartly users can also click on a link to then port over to join StashAway, because we knew the Smartly guys from their inception, and they were actually pretty decent guys. We like their sincerity and how genuine they were about developing the space. But it's really not for the faint-hearted, right? So they only raised 400,000 Sing, whereas we have 27 million Sing. We operate in 2 countries right now, Malaysia and Singapore, and are also looking at Dubai and also Hong Kong and also Thailand, whereas they were just in Singapore, right? So there's operational difference there. And after they underwent some difficulty, they basically transferred the ownership of the co-founders transferred the ownership to their licensing partner. They were piggybacking a licensed partner called VCG, a Vietnamese group. And VCG didn't want to run it, I guess, for a prolonged period, and they actually reached out to us to see whether it was possible for existing Smartly customers to be ported over to StashAway. So we were already going through the motions of having them, I won't say go under administration, because they're not bankrupt, it's just they've decided to close down. So we've decided it's more orderly, right, this way. And we were already working with them. It just so happens that it's happening in a very bad time. And then people are putting 2 dots together and thinking that, oh, tough times like the Corona crisis mean tough times for robo-advisors. But very good robo-advisors, like StashAway, we have not just the strength of the firm, but also we have different products within our portfolio for people to move in and out from. And basically the flexibility to withdraw your money anytime if you're really that worried about the platform is completely up to you as well.
Yeah, I think at this point in time, a lot of people are just concerned about the market, right? How is it going? And people
And
are
they should be.
Yeah, definitely. And people are shifting money out of the platforms. Not just your platform, but any other brokerages, So money in and out, it's pretty normal, right?
Yep.
So I'm kind of curious how you guys managing this part, in terms of all this money inflow, outflow, and how are you comforting your customers to continue to stay long term? Because from what I understand, you guys are very much long term kind of investors. Because I mean, you buy ETFs, you buy gold, diversified portfolio. If you're not long term, I don't know what you lah. Huh? So chances you are long.
We are long term.
Yeah. So as long investors, and as a robo advisor, I think one of your challenge will probably be a lot of younger customers coming on and being new to the space. They may not have the comfort and capacity to tide through. So how are you guys helping them to understand the situation that, actually this is just a natural market thing, and what are you guys doing to just kind of work with them and give them comfort?
Yeah. So actually, just one aspect of your question there, I want to frame. I think it's also a common misconception that robo-advisors attract only new and inexperienced customers and investors. In fact, our leading customer segment is actually bankers, followed by government servants in Singapore, followed by people in tech and then consulting. So these are pretty savvy people. In Malaysia, it's bankers as well, because bankers know a good deal when they see one. They know they've been ripping off clients for the longest time. They also want to invest their money overseas, right? So they are the leading segment here.
Sorry, I really wanted to jump in there because you did mention offhand there, bankers notice, or they know a good opportunity when they see one. Like,
for sure.
For those who, because there's also a bunch of people here right now watching who might not be bankers, they might not understand that. What is that opportunity that you're referring to?
So I think banks are set up in a way where really their operating structure is very expensive. So it's not, for asset management specifically, is the distribution or the selling of ETFs, which are very or funds or unit trusts, which are very expensive. So because they get more fees distributing unit trust, they tend to charge a lot more. So what I was referring to is those bankers know that unit trust itself is very expensive. And when they see a platform like ours, which has no sales charge and only 0.8% management fee, they're like, yep, this is a good opportunity. And they also know that it's very hard to invest overseas, right? So it's very hard for investors to access global markets because there's FX charges. Sometimes you need to open accounts for Malaysians, You need to open accounts in Singapore or Hong Kong to do that. And it's not easy to do that, right? The KYC is very high. So that's why I think bankers like our platform. But coming back to Reggie's point about how we are communicating with investors and how we are faring in this environment with some outflows. So first of all, I'll say obviously people are never happy when they see negative returns. So we have experienced higher than normal outflows. I can't be specific about the numbers, obviously, but I would say that in Malaysia, the inflows are still as high as the outflows. So basically, we're net neutral and slightly positive on some days. Whereas in the bad times when the markets were down, 10+% on one day, we did see obviously some net negative outflows, which is normal. People panic a little bit. So I will say that that's normal, but on the whole, we are really quite kind of neutral now. In Singapore, we are still very much in the positive. Again, because we have different choices, right? We have a money market fund there, we have an income portfolio there, right? So people naturally want to switch between these different funds. And the point I like you mentioned, Reggie, is about the communication, right? If let's say we had some of our money invested with a fund manager, you probably won't even get an audience with the fund manager, right? Like what's your asset allocation now? How much is in cash? What do you think of this stock? What do you think of this? Like there's no communication because the active fund managers, they cannot call out their plays because every active manager is competing against an active manager. I can't say like my big bet is on this small cap because then everyone will flood in, right? So naturally their comms is also limited. So for us, we really focus on the facts. So in all our conversations, and you'll see this with our CIO insights, you'll see this with a market update on YouTube, you'll see it inside the app as well. If you're a StashAway customer, you'll see the inside the app. What you will see is that we always talk about two things. We talk about personal finance best practices, the things we talked about earlier, and then we talk about what is happening in the market to give a sense, right? We don't light our hair on fire, run around and saying like the end is nigh, right? Like we give you numbers, we give you past data, we frame the issue, right? We don't sugarcoat things either, right? We tell you where it is, and then we try and come back to those fundamental personal finance and investing best practices like having a cash buffer, not using leverage, investing in a risk portfolio that suits your risk profile, right? And seriously thinking whether you're in it for the long term or not, right? Whether you're liquid or not. So yeah, I mean it's very disingenuous to change the facts, and it's not like we do that. So what we've found to be very useful is to reiterate again and again and again. And for us, it feels like second nature because we are a bit more, we're in the biz, right? But it is very reassuring for investors. We feel, and I think we are being very genuine by sticking to the messaging and aligning ourselves to the customer, because obviously they know they are going through tough times. One last thing, our customer service or customer engagement team is also available on hand. In Malaysia, we have a team of 10. So it's not an annoying chatbot that crashes when you ask about stuff. It's people, right? Human AI, right? Actual intelligence, not artificial, right? If you have questions about anything, where your money is, whether it's invested or not, how the markets are doing, what my performance. If I don't understand something on the platform, you can just WhatsApp us, you can call us, right? And this psychiatric help actually really helps in these times.
Fair, very cool. And
so we actually have a question from one of our viewers. So the question is this: if StashAway were to close down, must I sell off my StashAway portfolio? Because that's the main problem with Smartly in this down market. If StashAway closes in a similar down market, investors will have to realize their losses too, right?
Yeah. I think so. So that's the case. So what's not in question is definitely whether the money will be attributed to you. But I think, Christopher, you understand that that's definitely not the case. Obviously, if let's say you have to realize your losses, I think in an administrative process, I think that's logically what will happen, because if I was invested in something, I would first and foremost want my money back, whether that's 90 cents, 80 cents on the dollar, whatever it is, right? Also, the tough thing to actually maintain your portfolio is who is going to ultimately hold this portfolio and then in what structure, right? So I think liquidating the whole thing is actually the cleanest way to go, because you might be a very savvy guy and you want to hold on to your portfolio, but if you want to move to another robo-advisor, they have different ETFs and they can't house our ETFs because on the back end it will be very different. But at the same time, you can't actually directly hold it, right? Because the custodian account is in our trustee's name, right? Not your name. So it is owed to you for sure, but it will be in cash flow.
Perfect. Thank you so much for that. So let's get that. So I guess moving on. So last week or the week before, the last 2 weeks, like every single government started like announcing their stimulus packages, right?
Mm-hmm.
How has ERA responded to that?
Yeah. So like you rightly pointed out, each country, including the US, including Malaysia and Singapore, have a variety of tools at their in their back pocket to basically deal with the scenario. And a big part of this stimulus package is to support financial markets and to give direct handouts to people in the best way possible, right? Not trying to say that handouts are bad. How is ERA dealing with it, right? So we don't interpret these policies and try and feed them into the model. The model will respond to the effects of these policies. But because the model was already built based on stress assumptions from the global financial crisis and before that, it's mainly the global financial crisis because QE really started then in the US. So the stress testing really began then. So because of situations like that, where we saw the market turn around after the stimulus was enacted, the platform didn't actually recommend to change the asset allocation, because it might be a situation where you've timed it wrongly, where the system jumps ahead of what it's supposed to do and switches to safer assets. And then if, for example, the policy stimulus actually puts a flaw to the recession and actually even helps with a little bit of a relief rally, then you miss out on that, right? So yeah, I think we don't try and do too much to second guess the platform, because it was already built with these assumptions like the GFC in mind.
Okay. I guess that said, do you predict like a recession, or do you see us in a recession right now?
Yeah, very, very likely that we could be in negative territory right now. The technical definition of a recession is two consecutive quarters of being in negative territory. But if the question is, are we in negative territory? I think it's very likely. But again, if we take that human approach where we put a finger in the air and see where the wind blows, then it might not be exact. So we are still waiting for some leading indicators to come out to show that. And the interest rate expectations um, and also the jobless claims that came out and industrial production that will come out very soon are things that will guide us to whether we'll actually be in a technical recession and what to do with asset allocation.
Perfect. Thanks so much. Reggie, anything on your end there?
I think so. I played with the platform before, so I kind of scrolled through like supposedly the riskiest and the most conservative,
Yep.
and I on the riskiest side of things, I see exposure in kind of pharma companies and exposure in like additional exposure in pharma and tech. Right, essentially that's kind of where most of the growth drivers will be at, right? So when most of my audience are like young people, right? So like millennials, or like 30, 40, 30s, 20, 30s. That's where it is, right? So what does it take for people that around this age, young PMETs, taking on the riskier assets? Because I do see the growth drivers there, but I'm wondering how should they kind of manage their kind of expectations when they look at this kind of stuff.
Yeah, great question, right? It really depends on the individual. It doesn't matter. It doesn't mean that you're young. It means you must always go into the riskiest portfolio. If you're a new investor, you definitely want to understand each constituent in the portfolio. I think Reggie's spot on, right? Understanding the asset allocation before you even invest is something you should do for everything, regardless of where you are, where you're investing your money. So firstly, we actually in the riskiest portfolio, we actually break down a lot of the cyclical sectors in the US because those tend to do well in the good times. Things like energy and things like tech, communications, those things really do well, and those are the main contributors to last year's good performance. Obviously, energy is beaten down, and I'm very glad that the asset allocation to that is only 2%. Pharma through healthcare is more on the defensive side, so it's good to have some of that. And for people who are just starting out, right? So for those who are starting out, really, you should look at your own risk preference and your own investment goals, because it doesn't mean that you only have one investment goal, right? So maybe you have one main goal to retire, another one is in like a relatively short term one. So if you're short term, if you have a short term goal, like let's say you want to put a down payment on a house in 5 years, then you want to pick a portfolio which is actually quite conservative and maybe even more balanced on the conservative side. And if you do like high risk, like for example, if you're a savvy investor, like you pick single stocks that are not blue chips before, you're a crypto guy, you're an FX guy, definitely this riskiest portfolio is nothing compared to the stuff that you've invested in before. No, really. If you're a Bitcoin investor, you're like, oh, this is really boring, man. It's all relative, honestly. And the range of like risky investors is also very broad, right? So I'll say in good times it's very easy to take on a lot of risk, right? But then you really find out how much you can take in tough times like this. So if you also want to understand how each portfolio has done, also look at our performance, and you can also see that in, let's say, tough times like December 2018 or even this Corona crisis now, you can see how much it has gone down, and ask yourself, if let's say a portfolio is down 20%, can you really handle it? If the answer is no, then you have no business being in that portfolio, and you really should be looking at portfolio which is even more conservative, right? So pick something balanced, maybe on an 18 to 22% risk index, and you'll be fine.
Fair. I'm quite curious, like where are you guys going towards, like your growth trajectory, right? So I think there's two main growth trajectory. One is your product growth, right?
Yes.
So are you guys, because like it's not just you guys, but most of the people in the market have a lot of coverage with like Vanguard, PIMCO, all those kind of big guys, big ETFs, and either they have broad-based coverage or they have like country-based coverage. But I was wondering, because my personal stand is more and more of the growth drivers will come in Asia, right? So in Southeast Asia or in China, all this kind of sectors. So are you guys going towards getting some sort of ETF coverage within this space? Like more specific to this space. I think that is on the product side. That is
Yeah.
the one question that I have for you. You want to take that first?
Yes. So when we look at things from a product side, we really want to fulfill three main criteria when it comes to wealth management needs. The first one is wealth accumulation, right? And that is very broad, obviously. We'll touch on that later. And then the second thing is yield or income, and the third thing is cash management. So in Singapore, we have all three there right now, and we're looking to launch similar versions in Malaysia at some point in ringgit or maybe in US dollars. So we'll see, right? When it comes to certain themes within the wealth accumulation space, like ESG, like Sharia, like a China or Asia play, right? We really want to make sure we roll out all those other portfolios before we go into the thematic ones. And I myself, I cut my teeth in the asset management industry on China funds as well, right? So I like the economic growth. I believe in the economic story, and it's actually managed very well in terms of the economy. But somehow there's always a bit of a mismatch between the markets, the Chinese markets, and also and also the economy, right? The economy is like this, but the market is like crazy, right? So it's really crazy. So I think we're still looking at that Asian theme, whether it's gonna be predominantly Chinese or we're gonna mix in some other things. So because the existing portfolio is global and is multi-asset in nature, we also want to replicate that and to run it through the back test of whether you can handle or benefit from ERA itself. If it can, then of course we'll launch it, right? Because then it's a great product, and maybe people will want to express their view based on where they see growth coming from, like what you mentioned, or maybe they just want to take a different kind of FX risk. So yeah, it's in the works, but no timelines right now, and it's actually I think strictly still in the R&D phase. There's not really any kind of commitment of when we'll launch those. But yeah, I mean, China to me, it's a love and hate relationship because in good times it's amazing, in bad times it's so bad because of the retail participation is so high, and then there's certain certain idiosyncrasies, like for example, if we buy it through the H shares, there's always like a valuation gap with the H shares, so it's a strange thing to play, right? Because not everyone can access China directly.
Yes.
But yeah, it's an interesting place for sure.
Yeah, definitely. And what about business growth? I heard you guys talk about like you want to expand to Dubai, to Thailand. Like how do you choose your next expansion? Like why do you go to these places? I think that's pretty interesting also.
Yeah, so a lot of startups, right? They think it is a matter of the more users I have, the better. But for us, it's really about the AUM game, and we look at wealth markets as opposed to like demographics, right? Like just Indonesia has a lot of people. Let's go to Indonesia, right? Like this, we're not a Traveloka or e-commerce, right? So we look at wealth markets, and if you look at wealth markets, you pretty much make the same conclusions as us. And then the second thing we look at is the regulatory certainty. We like jurisdictions that have very clear ways of doing business and very clear guidelines of how we're going to set up in terms of being a robo-advisor. We don't just want to go inside and be like, yeah, you're a fund manager, right? Then you're like, oh, then I have to put like that much money aside like a fund manager, like a traditional fund unit trust provider. You have to have this kind of operational setup where each one has its own CDS account, each one has its own trustee. It's just not possible sometimes. So we need to look at countries which really address the fact that we are a tech player with a different value proposition, and that we might be doing things in an operational way that is different, but at the same time have internal systems that ensure good corporate governance. So we like those two main factors, wealth and also a good stable regime. Singapore, Malaysia.
It runs in the essence of the company, right?
Exactly.
Okay. Thanks for sharing. Yeah.
Actually, I'm surprised when you say that. Like, I don't know much about Thailand, but I never knew Thailand fell in that space.
Yeah, it does. It does. Actually, the tech side of things, they're actually very progressive. The SEC there is very progressive, so they actually have a framework in place. And hey, I think it's a matter of exposure, right? Like in Malaysia, we are like, oh, I don't know how rich the average Thai person is, but if you studied abroad in the US, in the UK, there are no poor Thais. The people who are there are CRAs, like just anecdotally speaking, right? They're like CRAs. So it's a very unique market, very hyper local market as well. So we also see the same market structure where you have big banks, expensive unit trusts, middle class wealth, a lot in cash, right? So that's what we like to see. You want to go in, disrupt it a little bit, give them a run for their money. Not easy for sure. They have their own regimes in terms of taxation. They have their own regime in terms of investing abroad, but it's still worth it, right? It's a market that is very exciting. I'm going to keep my job. I'm not going to be country manager of Thailand, by the way. I really like Malaysia. There's so much to do here.
You can't do two countries at once,
It's very hard, lah. It's very hard.
Cool.
Okay. And so I'm very cognizant that we are hitting that hour mark. So we just have three main things. These are super short. But for those who are currently invested right now with StashAway and going through this, this roller coaster of a ride, what do you have, or those who are just invested in general, like what are some of your suggestions to them right away?
Yeah, I would say review your portfolio and recognize how your emotions are affecting you, right? So feel your emotions, but recognize them. So if you wake up, you look at Bloomberg and it says like, has the word circuit breakers and has the color red, right? Then recognize your emotions and know that you're already a little bit biased, and the herd mentality is to head towards the door, which is the absolutely wrong thing to do, because it's not like other crises. It's not like the global financial crisis where the soundness of the financial system was in question, right? We were talking about banks collapsing, not airlines collapsing. This is not like the tech bubble where you are invested in like pets.com and like you know the company's worth nothing at all, but what you're investing in now is sound. It's just a matter of timing, right? We're talking about broad-based ETFs in multi-asset portfolio that is fundamentally sound. So it's about recognizing the risk, right? If you are liquid, I would say continue when your dollar cost averaging strategy. For those of you who are a little bit more cashed up for moments like this, do drip feed, right? Because we're not calling the bottom yet. Drip feed, I would say like 5% of your portfolio, 10% of your portfolio, every time you see a big drop. That's what I've been doing. And then, do you have time, right? I'm saving for my retirement, saving for my kids' education, my theoretical kids, right? So for those of you out there who are a little bit more long-term focused, right, like just write it out. Of course, there are very unique scenarios, like let's say your portfolio is keeping you up at night and like really you're very stressed out about it. Yeah, look at switching to a portfolio which has less risk, more balance. And then, of course, if you really need the money, let's say you been put on no pay leave, it's a tough situation and you have to feed your family, then of course sell. I'm sorry that you've been caught out in a bad time, but you have to sell. Those are the facts of life.
Mm-hmm.
And it had to be pets.com, right?
It had to be, right? What are those curious names? Oh yeah, MySpace.
MySpace. It's like if you are in the space for long enough, you hear all these names. They're like the classic rubbish. Yeah. So yeah, it's
yeah, haven't said that name in a long time, right?
Yeah, man. Pets.com, MySpace. Yeah. I know. I wonder what's
MySpace listed.
Yeah, I think was it Microsoft that bought it over so that shit don't get banned or something, but I can't remember exactly. But yeah, they were listed.
To be fair, MySpace was very revolutionary for its time.
Yeah. Okay. Frank was very revolutionary for its time.
All right.
They were not making money. But it's okay.
Let's go back and find CS's profile on MySpace.
Yeah. I'm sure you're there. Yeah.
Friends, maybe. Good luck. But okay, so how about for those people who, this is their first time they like start paying attention to the market because everyone's saying, some people are saying doom and gloom. Some people are like, this is the best time to get in. So they're kind of on the fence for investing. What would you say to those people?
Yeah. If you are on the fence, I would say definitely pay more attention and read the financial news with a little bit more, should I say, like apply yourself a little bit more. Because if you read the financial news or you watch Bloomberg or CNBC, they'll have talking heads like this. One guy is a bull, one guy is a bear, one guy is a salesman, and everything else in between. So you have all these different actors, right? So you really want to be discerning about who you want to listen to. So I personally will listen to very, very sane people. So yeah, definitely catch our CIO Freddie if you haven't read his CIO newsletters. But outside of my company itself, I really like this guy called Muhammad Al Arian. He's Allianz global economist. He used to be co-CEO of PIMCO. He's also a macro guy, so he knows what he's talking about, right?
I love him. Every time he comes on show, I was like, okay, listen, this guy quite legit.
Yeah, he's very legit, right? So I if you're new, I haven't invested before, I would listen to Muhammad Al Arian. He breaks it down quite well. I would also say invest a little bit of money, and that's the good thing about fintechs like StashAway, right? You don't have to start with $10,000. You can put like $100, $1,000 and start. Because if you don't start honestly as an investor, it's just theoretical, right? You can paper trade, sure, yeah. If you're picking stocks, yeah, paper trade, see whether your method, your discipline works. But if you're with StashAway, you look at the back of your couch, you'll find $100 already. So, just try and then feel the ups and downs, understand your emotions, find your risk preference, and then ultimately learn about the constituents of your portfolio. What's keeping it afloat, what's dragging it down, learn about asset classes, listen to the CIO newsletter and talks like this, and ultimately make you a better investor all around.
Yeah. And for the final thing here, what's your advice for university students or people who recently graduated?
You're screwed. No, you're not screwed. It's
Good
fine.
luck.
There's still a market out there. You mean for career advice? Yes.
Yeah. Well, career advice or just money advice, right? Because they're now coming to a world where they need to really start thinking about money. So investing is one piece of it, but there's
money. Yeah. Okay. So we'll stick to money then. Money wise, I would say don't underestimate how expensive things are. As a relatively young person, you might think that you can like casually do something and still succeed. Like maybe you're very clever and like can still like play a fool and still pass your exams, right? But like facts are facts. Only 0.5% of Malaysians have more than 1 million in their EPF. Only 1% of Malaysians have more than 700k in their EPF. And even if you have 700k, you divide that by 12, you divide it by 20 in terms of how long you're gonna live. That's not a lot of money, right? That's like $4,000, and that's your starting pay basically. How can you retire with that amount? A decent retirement is gonna be in the range of 2.4 to 3 million ringgit. So casually saving and all that is not gonna work, right? Because actually, with time on your hands, you just have to put very, very little aside to actually get compound interest in your favor and actually reach your financial goals. So in terms of money, I would also say that when you get your first paycheck, really read it, because there's things like taxes, there's things like EPF, there's things that get taken away and your net pay is actually a lot less. Then you really want to revisit how often you visit Zouk, how often you buy your avocado toast, right? So saving is great, but like really you're just running in the spot because inflation just eats away at it. So really start looking at investing as soon as you can. And this is always a personal experience, personal anecdote. If my dad didn't bring me to get a property that in my first year when I'm working to service a mortgage, I'd be priced out right now. I wouldn't be in this house in my own name paying off my mortgage. So try and buy in Singapore, obviously very different, right, Reggie? But in Malaysia, there's a downturn in the property market. You want to look for somewhere to stay for yourself, right? So you can service that mortgage. And ultimately, when you're going to get married in your 30s and all that, you'll find that, it's good advice.
Nice. I think a lot of Singaporeans are also contemplating Johor now.
Oh,
Yeah, it's like, yeah, it's getting a bit tough in Singapore, but it's okay. I think in general, it's just a different way of managing finances. Yeah, that's
true,
cool.
true. Like rent versus buy, right?
Yeah, that's a whole different discussion. We'll do it another time. But yeah,
Correct.
Yeah, and I guess my own thoughts, just adding on to that, is as especially once you're like done school and you have more time on your hands, I would actually say like skip trying to learn how to stock pick right away, right? Because number one, you don't have that money to actually stock pick with, and so learning it's not as valuable at that point versus using that time to find ways to improve your skills, right? But you should still be investing, and that's why like I'm such a big fan of StashAway, right? Because it's one of those things where you can literally set it up in 30 minutes. It can automatically help like invest for you going forward, and then have that, and then you can spend the rest of your time and energy and focus figuring out how do you actually grow your income to the point where you can buy that first house, or to the point where you can look at buying the next big like Apple or whatever it is that you want to buy, right? But that's kind of just something else I just wanted to add in there. Thoughts on that?
Yeah, Reggie, you wanna jump in?
no, we're quite in sync. Yeah,
Yeah,
you're the guest. We're more curious of what are your thoughts. Right?
right. Yeah, I'd say there's definitely room for stock picking. Maybe not out the gate like what CS said, but I think it really depends on your own passion, right? If it's not really a passion of yours to understand companies, how they're affected by economies, to read those research reports, and take that risk, I really think it's something more accessible like StashAway is probably better for you. And there's definitely platforms that you can use to basically graduate to stock picking. So and then always make sure you, for example, you have your cash buffer in place before you start stock picking. Paper trading is something that is been advocated as well. And then definitely choosing a discipline, right? Like there's 1,001 ways to make money from the stock market, and you need to stick to a discipline, right? Are you a small cap guy? Are you a dividend yield guy? Are you a Malaysia only, Singapore only, or like are you a global guy? So find your journey and stick to a discipline of picking stocks. What I will definitely not do is pay tens of thousands of ringgit for those guys to teach you how to like read financial statements, and because there are all these spurious guys out there who you turn up to the seminar after like paying $5,000, and they say the real secrets is in the next seminar, and then they have credit card holders to take your money straight away. Those guys are very spurious. They are in the business of selling courses. They're not in the business of necessarily helping you get rich. There's a lot of resources online, guys. Like if you really want to stock pick, you really want to invest properly, tons of resources online.
Yeah.
Cool. I agree with that. Yeah.
Yes.
Well, okay. So last thing, not related to anything else at this point. But what books or materials would you suggest? Anyone right now being stuck at home, expose themselves to become a better or to better understand how to deal with money, or what do you
Right.
do?
Truth be told, I actually don't read too much these days. I think just have like ADHD, right? But the things I have read in the past 2 years, which I think are pretty good for times like these, is Ray Dalio's Principles. I think that's pretty good. I would also subscribe to Howard Marks' Oaktree Investments CIO newsletter. He's really good. Freddie from StashAway's CIO Insights are actually really good as well. Like what I really like, obviously super biased, right? But what I really like is that you have a too long didn't read TLDR version on top, and then if you want to really nerd out, you just scroll down and we can turn up the nerd meter pretty quickly, right? So if you really want to learn those stuff, you can. Otherwise, I do consume a lot of financial media. So I'd say guys like Mohammed El Arian, very very good people to listen to. And then Bloomberg also has a podcast on Spotify called Bloomberg Business Week that really helps you get a broader sense of business as opposed to just markets, because markets is just crazy day-to-day stuff, right? Bulls, bears, pigs. But then Business Week is really good because it gives you a broader sense of like ongoing themes, startups, corporates, and they have literally like a half hour, 45-minute podcast like every day. So yeah, free as well, right? So go for it.
Nice. Anything you want to add there, Reggie?
I would also go to Make Money Malaysia. Forgot to say. And then the shameless plug, right? Go to Make Money Malaysia and Financial Coconut.
It's actually more money in Malaysia.
more money, more money in Malaysia.
No, I think so. The only thing I would add on to that, I think what you mentioned there are great options from a like a financial perspective, but money is definitely more than just finances, right? And you've hinted at it multiple times. It's like understanding your emotions, and I would actually suggest books that really start helping you better understand what that means, right? So I haven't actually read Think Fast and Slow, but a lot of my friends have said that's a really good place to start. Of like, the whole fast ideas of seeing that market news and reacting right away, and it's the slow part is actually like stepping back and actually say, does that actually make sense, right? Does it actually matter at the end of the day? So I would suggest more books like that. Or for me personally, like I'm an advocate of meditation, spending some time with my own thoughts, allowing myself to really, it's not even just like meditation, but it's like almost sitting with myself and my thoughts and letting those thoughts come across and being able to decipher what is noise and what is something that I should pay attention to. And that's really helped me over the
moment, right?
Yeah. But that's definitely helped me a lot in terms of understanding and like being a lot more zen when in a day-to-day life. Right. Yeah. But yeah, I think that is it. Thank you so much, Ken, for joining us. Appreciate it. And thank you guys for, or those who are watching and those who might be watching in the future for joining in. If you have any other questions, feel free to leave a comment anywhere you watch this, and we will find a way to get you the resources to help you answer those questions. Hey, this is CS from More Money Malaysia. We are a platform dedicated to helping Malaysians like you make smart financial decisions. And the way we do that is through providing you with actionable advice, such as the video you just saw, right? But we're not here just to become your intellectual entertainment. We really do want to see you succeed, because we want to see you live that ultimate life that you've always dreamt of, right? And in order for us to do that, what we've decided to do is we want to help make it easier for you by providing different types of rewards throughout the months. So make sure you check out the description below, click on that link and see what type of reward you might be able to qualify for by taking action right now. And if you have any other questions about any of this, feel free to contact us wherever you find us. Take care.